Good morning to everybody, to our audience out there, and welcome back again to Boutiques on Wednesdays. Always really great to have you join our sessions. We have a fantastic lineup for you today with a very talented team from Methodical, and we'll introduce them just now. Joining us from their side, and first presenter is Ida Brashik, that will give us an introduction to Methodical for those of you who don't know them yet, and a bit of a business update in terms of where they are and what they do. Also joining him, his colleagues, is Equity Manager Shell Keith, who will take us through the investment process of momentum investing. What is that all about, and how that works or comes together in the Methodical BCI equity fund, and how they keep the odds in your favor. Sabran de Priya also joining us, no stranger to most of us, extensive experience in portfolio managers with houses like Old Mutual and Coronation before joining Methodical, and he will take you through the methodology in constructing the Methodical BCI Equity Preserver Fund, the fund that's very different, I think, to a lot of other funds we know out there, and reshaping equity market returns and how they do that. And then last but not least, on their side, JP Duplessis, also no stranger to us, 20 years of experience in that includes companies previously like Lorium and Prescient, and here to answer the question if higher yields compensate for higher risk. And I think we all felt a bit of that in May, talking us through the Methodical BCI income and bond funds. Gentlemen, absolute pleasure to have you all, your whole team here with us today, and we're really looking forward. We're going to cover a lot of ground, so we need to watch time. Our audience out there, you know how it works, Q&A box. So if it's any questions you want to direct to any of the speakers, just tell us who you want to pose a question to, and we'll cover those questions as much as we can after the presentations. Edo, if you're ready, you can share and we can start with there.
Excellent. Thank you, Gene. Good morning, everyone. Thank you so much for dialing in, and thanks to BCI and Gene for hosting us. If you haven't met us before or heard of Methodical, we're a Cape Town-based asset management business founded in 2016. We manage a wide range of unit trusts and seg mandates across the entire risk profile, ranging from income all the way to global flexible, mostly supported by the retail market. Current AUM is just over 6 billion rands under management. The funds are widely available on the majority or major platforms across the country. If you, for some reason, don't have access to any specific fund which you would like to invest in, please don't hesitate to give us a call to open up that fund for yourselves. With regards to the agenda, as Eugene touched on, we're going to start off with the Methodical BCI Equity Fund, which is, it reached its 7-year track record last week. It's going to be presented by Shell Keith, who is the co-portfolio manager of the fund. And he started managing that fund with myself about 6 years ago. And then Sabran de Priya is, again, as Eugene mentioned, no stranger. He's going to touch on the Methodical Equity Preserver Fund. And then last but not least, we're going to have JP, who heads up our fixed income capability at Methodical. So short and sweet from the business side, because I think that's the boring stuff. Let's get stuck into the nitty-gritty details of how we manage the funds.
Morning, everyone. I'm Sean Keith, as you mentioned, the portfolio manager of the Methodical BCI Equity Fund. So apologies if you've seen this slide before, but if you want to box or label us, as you mentioned, we're a momentum or trend following investor. We buy stocks based on price trends and the probability of that trend continuing higher. So people that often don't realize it, but every decision we make is based on probability. And it served our ancestors as well for survival, but now we can also use probability to make decisions in complex systems like the stock market. So how do we incorporate a rules-based, probability and rules-based approach? Unfortunately, we don't have a crystal ball or perfect information, so we don't know what the stock will do in the next day, month, or year. But what we do know, however, is that stocks trend up more than down. If you look at the left-hand graph, the S&P, the past 80 years, So it's bottom left to top right. It's clearly an uptrend. It's not stationary. And then stocks trend, and then the probability of a stock being up, or the stock market being up next month is about 60%. This is based on historical information. Another way to visualize this is on the right-hand side, a roulette table with 60% odds of the ball landing on red and 40% landing on black. If you spin that wheel 200 times and you conduct that experiment another 100 times, not once did you lose money in the long run. Unfortunately, we know being right 60% of the time doesn't mean you're making money. This is because stock returns aren't binary. Stock returns can be way more extreme than investors can imagine. They can go up a lot more than you think, and also down a lot more than you can imagine. So this is what people refer to if they talk about fat tails. This is the extreme events in stock markets, and that's extreme downside and extreme upside. And the issue with these extreme events is there's no cap. A share that fell 90% last month can fall 90% again this month and 90% again next month. Same on the upside. The stock that went up 100 or 200% last month can go up 100 or 200% this month, and so forth. So we want to position the fund to survive those left-hand extreme events, the value traps and the permanent loss of capital, and then also benefit from those right-hand tail events by staying with the trend until it turns. And this is exactly what a momentum trend following strategy does. It drives the winners and cuts the losers short. On the right-hand side is just is attribution on a share level of the Methodical BCI equity fund for the past 3 years. As you can see on the left-hand side, we have many small losses as we cut the loser short. And on the right-hand side, we have a few big winners. And just like the spin of the roulette wheel, the more you employ the strategy, the better this graph will look, the bigger your winners will be and the relative to your losers. There are just 2 examples, and there are multiple of left tail events and right tail events. Left tails, we all know Steinhoff, Bolt and Blue, December 2017. The day or the weeks preceding it, falling 95%. The stock was already down 50%. It might have looked like a bargain to some investors. And then recently, it's down another 95% from after falling 95%. So that's a perfect example of a left tail. Right tail, Tingela Resources, after a few weeks after it listed, it's already doubled in price. A few weeks later, doubled again, and so forth. And it ended up 1,800% from its initial listing price before starting to trend down. So we all know markets are dynamic. All the information in stock prices changes constantly, and a rules-based process will continuously adjust to incorporate all relevant information. And because we believe all information is already in the price, we only look at price trends. As the price trends higher, the probability of outperformance increases, and thus will increase our weight in the share. And vice versa, as the price trends downwards, we'll start cutting from the share price allocation. This is an ongoing cycle as new information is processed in our algorithms. So to sum up, a rules-based momentum-driven process will allow us to accumulate good decisions and avoid bad decisions while keeping probabilities in our favor. And then, does this strategy deliver returns? As Edu mentioned, we recently had our 7-year track record. On the left-hand side, we have us versus the peer group. As you can see, we are a top quartile manager on virtually every look-back period, except for 3 years. Maybe just a quick mention, if you can think back 3 years from today, we were deep in the COVID pandemic, and the Methodical BCI equity fund had one of the shallowest drawdowns, because we avoided those left-hand tail events, the COVID crash. So we didn't fall as much as the peer group. Then on returns, because it's equity fund, we don't think looking at anything shorter than 3 or 5 years rolling is fair to the fund. And as you can see, on a 5-year rolling basis, we've never been below the peer group. And just to finish this off, it's a different process, so the outcome will be different. There's a correlation matrix of us versus the 5 largest managers in South Africa, largest equity managers that also has offshore exposure. As you can see, we have the lowest exposure to all the other managers and to the peer group and to the all share. So it provides a good diversification effect for fund allocators. And that is me from the equity fund side. I'll give it over to Sabant.
Thanks, Charles. Investing in equity markets is like driving through mountainous terrain. There's very good returns to be had, but there's also downside risk and dealing with uncertainty. We can't see around the corners. And to address these issues, we've introduced the Equity Preserver Fund that gives you exposure to the domestic equity market. It acts as an investment vehicle that can take you safely through our local equity market mountain range. I'll describe how we manage the fund, and I'll point out specifically how we reshape equity market returns in the hands of the investor, and also how we cater to compensate for the uncertainty when investing in equity markets. And I'll conclude with 1 or 2 thoughts on the role that this fund can play in a client's portfolio. Jumping quickly to the right graph there, a typical histogram of equity market returns. Our approach is very simple. From a given starting point, we try and limit and cut out first losses. So those red bars in the return distribution, we try and eliminate those. That will pull the whole left-hand tail to the right, which means in losses should be less severe in the hands of the investor. We focus on those green bars, making sure that we capture first returns. And yes, nothing is for free. We might forego some or most of the far right blue sky return. So that's our approach. Limit first losses, capture first gains. Let's see how we do it and what the outcome will be. If you follow that approach, slowly rising market, you'll perform in line. You're in that green bar zone. When markets turn volatile and start to swing up and down, this is when this strategy can outperform. Our protection overlays can lock in returns and reset exposure to the market at lower levels. Strong rising market, we will lag the market outcome because of the hedge effect of those overlays. Also, a very strong falling market, we will outperform the market because of the risk management, but we might still generate negative returns, albeit much smaller. So how do we do it? As a first step, we create full investment in the domestic equity market by buying physical shares, the bulk of the investment, and the remaining cash we cover long equity market index futures. So you long the market, you move up and down with the market. Next important step is we put wheels to this investment vehicle. We add 4 protective overlay strategies, each 12-month in duration, but offset by 3 months each, coinciding with the quarterly expiries of SAPEX in March, June, September, and December. So at any point in time, when you cut through the portfolio, you'll see these 4 strategies in different stages of maturity. And yes, there is a spare wheel, the 5th one, a cash bucket. It's a unit trust. All the small in and outflows are accumulated. And when sizable, we allocate across back to the strategies to keep them roughly evenly allocated in terms of investments. A typical payoff profile at the bottom there, that's the expiry profile, the blue line. There's that element of buffering against those red bars, the protection buffer. We participate in first upside, and we may be capped or forego some of the blue sky returns. So there's a payoff between how much protection and how much upside. How does that play out? So on a quarterly basis, when we need to replace one of the structures that's maturing, those are the four wheels, we walk around the vehicle and kick the tires. We look at how well are the existing structures positioned, protection-wise, and how do they participate in the market. The next step is we look around us, look at what's happening in the world. What recent trends do we observe in the equity markets, local and international? What lies ahead as far as we can see? Major events, elections, economic data, and obviously what's happening in global economics growth, and how does that impact our market. So we get a holistic view. Based on that, we design, say, 1 or 2, 3 potential protection overlays where we match those protective characteristics with upside participation. And after internal debate, well, we fit that newly tuned wheel to our vehicle, and that vehicle can then drive and generate returns for the investor. And this is a means to handle the uncertainty. So remember, every quarter, we've got the opportunity to reset a quarter of the fund's positioning in the market. So we can evolve our protection as time goes by and the market goes through its gyrations. So how did this vehicle perform over time? The red line is the strategy, blue line, the benchmark, 65 all-share index, 35 STEFI, that's to reflect the hedged nature of this investment, and the gray line for reference, the all-share price index. 1 or 2 observations, we can see those scenarios playing out. Slowly rising market there at the beginning, we perform in line. As soon as there's volatility, the strategy starts to lock in returns and the crocodile jaws open up. We start to outperform. And then in a strong rising market, this last, it's now been a few years, the strategy lag when there's spurts of very strong upwards market move. But just to zoom in a bit closer to 1 or 2 aspects, look at the last 5 years. The red line is the strategy and the blue line is CISA general equity average. What I want to point out is that visually, the red line is smoother than the blue line. And we see that the standard deviation or volatility of returns is generally half that of, in this case, general equity, but also if I do the same measure against all-share index. That's the one aspect, smoother right. The other one is obviously drawdowns. The huge drawdown, COVID, the fund did just minus 6%, and we nearly saw minus 25% in the equity sector. And in the end, this vehicle gets you safely through this mountainous terrain. Reshaping returns on the right, those are the actual rolling 12-month returns placed in a histogram. You can see our intervention on the left there. There's no red bar or strategy returns providing large drawdowns. We've contained the returns in this green bar section, participate in first returns. And yes, we did miss out on some of those blue sky, but we still get you there in the end. How is this fund useful? Let's just briefly look at, say, a moderate portfolio with, in this case, a chunk, 40% of equities. In one scenario, you could have a case where you need the growth exposure to satisfy a client's need over time. So you have to have that 40%, but risk is a problem. When you introduce the preserver fund, you'll maintain your growth exposure, but at with much less risk. By the same token, if you're very bullish on equity markets, you can, for instance, go overweight equity, enlarge your growth asset exposure, but without a one-to-one increase in risk. I think I very briefly touched on how this investment vehicle that takes you on a drive through mountainous terrain can really smooth it out for the investor, because we reshape those returns. And I think that the fund has demonstrated over time that it's a very useful equity building block to rebalance the risk-return characteristics of the portfolio. Thanks a lot.
Say right. Okay. Yeah. So I'm Jacob BCI, as Eugene mentioned. We're talking through the fixed income proposition that we have here at Methodical, and then try and answer the, I guess, very topical question: is do high yields currently compensate you for the higher risks? Don't worry, I won't be too depressing. As a fixed income manager, that is an unfortunate trait. The first thing I'm going to talk about is the fund's objective. I think it's very important to think about what the investors are trying to achieve. We can talk a lot about products in abstract, but what is the actual investor trying to achieve with the product? What are the benchmarks that they're trying to outperform, and then what are the kind of risks that the investors are comfortable with taking? So I think that's very important, especially when you distinguish between, say, the income fund and the bond fund. You have to think about the opportunity for return as well as the risk that you're taking, and that I'll show through on the slides. So firstly, on the income fund, the formal benchmark is STEPI +1, so to beat cash. We've been through a period now where cash as cash rates have been going up, so beating cash has been quite difficult. But that's the formal benchmark. The other is sort of informal benchmark, and important for income investors, is to beat inflation. So inflation is the biggest eroder of wealth in savers, particularly income savers, and so we need to be focused on those two things. So beating cash, beating what's available in cash, and then beating inflation. But to do that with that risk objective, which is no drawdowns over a rolling 3-month period. So very, very sharp focus on risk, because typically income investors are shorter term in nature and are concerned about drawdowns. And then the bond fund is for longer term investors, comfortable with taking a little bit more volatility, higher duration, high yields, but it does come with a degree more volatility. So that's what you get in those two products. So firstly, the income fund, I call this a toolbox. What kind of asset classes can I invest in? And then at each stage, think about the kind of volatility that can introduce. So on the extreme, if I put the entire 100% in, I can't due to but let's say I did. But in property would be an extremely volatile performance, and there's the large risk that you're going to underperform your objectives for periods of time. Equally, I can go very conservative with money market. I might be able to achieve cash +1, but there might be periods where you underperform inflation. So you've got to balance all of these out with the various returns that are available and the various risks. I'll talk a little bit about how I do that. So this is the current situation. Apologies, very busy slide, but the two red ones are the most important, I think. The one is the first one is just looking at what is STEPI +1. So what is the current market pricing where cash, what I need to do over the next year to be cash +1%, and that's 10%. So that's what you can that's what you'd want out of this fund over the next year. And then if I look at where kind of inflation expectations are, inflation what's priced into the market is around 6.3% priced into the market. So if you want to beat inflation, it's relatively easy relative to the cash +1. So you've got to bear those two kind of objectives in mind at points in time. That's not always been the case. We had period post-COVID where the repo rate was incredibly low and inflation was already ticking higher, and it was much more difficult to beat inflation at that point in time. So those two things, interact. And then you can see the various other asset classes here that can be used to get to higher levels, NCDs, inflation-linked notes. And then on the right, the far right, is the government bond curve. So you're taking a bit more duration, but you can get higher return. I'm going to touch on whether I think that's attractive or not. So I mentioned the 2-year inflation swap. We obviously had a period during COVID where inflation was lower, but we've since recovered, and inflation is now unfortunately quite sticky on the upside. And so we've seen inflation expectations come off, but now start to tick up again, and that's obviously what the Reserve Bank is concerned about, and the reason why they keep on putting up the repo rate to try and control that inflation. A lot of the inflation is driven by the reduction in capacity. Again, I'm trying not to be too depressing, but we do have a load shedding that nobody needs to be told about load shedding, and a lot of constraints on the capacity of the economy. And when you have a capacity constrained economy, inflation is likely to be there. Another big factor that we're seeing, and another thing flagged by the Reserve Bank, this is actually from their latest financial stability report, which got headlines over the last week or so, is that foreigners have been, foreigners in the light blue here, as a percentage of our bond market, they've been exiting. This is slightly unclear because we have been issuing a lot of bonds, so it's not necessarily pure sales, but they just haven't been participating to keep their percentage of the bond market at those levels. We were one of the higher, if I look at the EM, kind of the broad EM, we were one of the higher owned markets. Obviously, we have sort of relatively deep financial markets and liquid and sophisticated financial markets, and foreigners like that. But there has been an exit, and obviously there's kind of geopolitical concerns which are on the go at the moment with the Russia situation, which also is I guess a tail risk that foreign investors are thinking about. So this slide just shows you the sovereign bond curve. The dotted line, the dotted green line here is where we were at the end of last year. The solid green line is where we were a couple of days ago. And you can see there's been significant sell-off in our bond curve, predominantly around the risks of, I mentioned, inflation has been sticky. We've seen now likely, the IMF came out yesterday and talking about the likelihood of bigger budget deficits than were forecast, and obviously higher inflation and bigger budget deficits aren't positive signs for the bond curve, as well as obviously this reduction in ownership by foreigners. You can see here that we were, if we go back, 2016, this is looking at the sovereign spread, the orange here is South Africa and the blue is the emerging markets credit spread. We were tighter going back, what is that now, 7-8 years, and then we sort of traded in line, but we've now got to the stage where our credit is trading wider of broader EM sovereign curves. And that is as a result of those idiosyncratic risks that I talked about, load shedding, and obviously now the geopolitical risks. And I think we need to solve those two things to see our sovereign spread start to trade at least in line again. And then obviously, if I think about bonds, we are fortunate in that we have a large amount of issuance in rands, so our national treasury is borrowed heavily in rands. But what that means is that the rand acts as the pressure valve. If we see concerns, global concerns, as well as idiosyncratic South Africa specific concerns, and the rand has quite significantly sold off versus its long-term purchasing power parity level. And I think we need to see, as I say, some resolution of the issues that we're currently facing to have the rand and bond yields come back to better levels. So just an example, a brief example of a trade in an investment in the income fund and how it fits within the income fund. So if I go back to April of last year, I bought a significant portion of the income fund in inflation linkers. At the time, real rates were at 3.4%, i.e. you were getting paid 3.4% above inflation at that point in time. The inflation swaps were at 5%, so your kind of expected yield, as I showed in the earlier slide, was around 8.4%. At that point in time, I was expecting inflation to be stickier and to not come off to that 5% level. And then on the right-hand side, you can see what headline inflation has done over that period. And it's been significantly higher than that 5%, which means that the returns have been higher. I was comfortable with only earning the 8.4% at that time, but I felt like the risks were that inflation would be sticky on the upside, and obviously that also protects your income investors from from inflation being higher. So briefly on the current portfolio, I've mentioned ILBs. I still have a significant portion of ILBs in the portfolio. I think while we have seen some moderation of inflation, it continues to be high and continue to have exposure to ILBs. The current yield of the portfolio is just below that 10%. The portfolio is extremely liquid, so I can move this portfolio around duration to 1.5 years. Typically, the fund will have between 0 and 2 years of duration. Obviously, depends on how much yield is available. So it's on the relatively high side of duration. But because of the high yields that I went into May actually below 1 year of duration, and I've added some duration over the last month or so. And then offshore, I've had some exposure to the US dollar. I do believe that it's a nice buffer to having that duration in the portfolio. If we see a big sell-off like we saw in May, the rand sells off typically in line with bonds, so it gives you some protection. And equally, weakness in the rand does tend to feed through into the inflation picture, which again is what you're trying to protect. This is the fund here again in red versus Steady Plus One, which is that cash plus benchmark, and which is the dark line there, and the grey is the inflation picture, which, as I've mentioned, when inflation was ticking up and higher, was hard to beat, but over time, that's the objective, is to beat inflation. And then the green here is the category average for that multi-asset income sector. Briefly on the bond fund, the good news is yields are higher. The bond fund yields are above 11%, but it does come with an extra bit of volatility. I'm short or underweight the long end of the curve, where you can see this kind of flatness, where you're not, in my view, getting paid appreciably for taking for taking that exposure. I'm long in the belly of the curve, around the sort of 7 to 9 year level, so taking advantage of that steepness of the curve and getting additional yield in that on a risk adjusted basis. That's, I think, attractive. This is the performance of the fund again in red versus the green of the index. I have steered clear of the SOE exposure, so I don't have Eskom and Transnet and other SOEs that are in the all bond index, which have at times outperformed the index and is largely responsible for some of this outperformance of the index over the time. But over the long run, I believe that it's better to just stick to the government. Well, certainly at the moment, I think it's better to stick to the government bonds. So briefly to end, do high yields compensate for higher risks? I think there is, and you can see that from the bond yields, that there are compensations for those higher risks, those tail risks that we have in the fund. But you need to be focused on what outcomes are required by the investors. So, while I can get very high returns by going very far out on the curve in the income fund, then I put the risks in the income fund that the investors wouldn't be happy with. So one has to bear in mind always the objective of the investor. And then I also like liquidity. So I've got a lot of liquidity in both the income fund and the bond fund to move the relatively small funds in the category. So I can be nimble and move as the risks change and valuations change. So that's all for me. Thank you.
Aha. JP, thank you so much for that. And gents, for really good presentations. You've covered a lot of grounds. I've got a couple of questions. We've got a few minutes spare. JP, maybe to start with you, and exactly what you spoke about now. You've shown that graph where, you know, foreign investors are almost leaving our bond market, which I find a bit bizarre, because I mean, if you look at yields on our bond markets relative to other emerging markets, developed markets, super attractive. We all know that. If you look at our currency, blown out, super cheap. Why do you think that foreign investors are not coming back to the SA market? In my mind, it's almost a no-brainer.
Well, yeah, unfortunately, I don't think there's anything that's a no-brainer in financial markets, because when you say something's a no-brainer, it's probably likely to go the other way. But yeah, look, I think you know, as I said to you, it's that line is probably not as dramatic as it seems, because you know, a lot of it's about there is larger issuance, so that you know the percentage of the market you know gets diluted if they're not actively buying. So it's not necessarily a pure active sell, but just not actively buying. I think, you know, one has to think about it in, I spent 12 years living in London and thinking as a global investor, and one has to think about things from a global investor's perspective. And if you kind of look at our percentage of global bond indices, we're still relatively small. You know, we're probably around 3% of global bond indices. So it's not like they necessarily spend a lot of time on our market. When you see headlines like load shedding, you know, poor growth, budget deficits, and then you know links and non-alignments with the Russia-Ukraine war, then all of those things are enough to just make you think: do I really want to, with this 3% bucket, really want to stress myself out? You know, I think that's what it comes down to. And obviously get a lot of research from global banks and investors, and you know they certainly don't. They're not seeing it as a no-brainer. They do see, you know, they certainly seeing the risks there, and I think for many of them they'd rather wait for some of these kind of tail risks to dissipate a little bit before they come in. So maybe they don't make the first money, but they make the last money. So I think there is a lot of money waiting on the sidelines, even in domestic. I think, you know, a lot of the domestic investors who have been picking up the slack have now reached this point where they're sort of getting quite full with SA bonds. And I mean, I think you'll know this, Eugene. A lot of guys, every time you pick up an article over the last 6 months, have been telling you about how attractive SA bonds are. And you know, so to that extent, I think SA investors are quite full. And so their appetite for taking more, you know, is limited, and it has to be on the basis that you know some of these are a bit clear. So I think that's what investors are waiting for, and that does mean it. You know, it could be a while before we see a rally, but equally, if these things, you know, if these things do dissipate, then we could see a significant one. But I don't think it's necessarily a 6-month trade. I think it's probably something beyond that.
But I mean, we've seen how many people got those bond calls wrong over the past 6 months. You know, as soon as you think you're at the top end of the yield cycle, you're more than likely not. You know, that's why I rather leave it to guys like you to manage the fund for me. I don't want to make those calls. That leads me into my next question in terms of your yield sitting at the moment about 9.8, duration 1.5. After the crack in May in bonds, are you looking to buy a little bit more, you know, on those lows?
Yes, you know, I've been telling my investors that it's been a bit like catching a falling piano in May. And that's not a technical term, but that's what it felt like. You know, so yes, I've been adding to duration, but But equally now, you've got to think about again, to sound like a boring fixed income person, you've got to be thinking about the risks and the volatility that you're introducing. So yes, I have added to duration, I've added yield, but one has to compare that to the the kind of so the income fund was flat for the month of May, which I consider a reasonable result given what bonds did. But equally, your investors are unhappy because you're not going upwards in a straight line. So one always has to kind of temper your enthusiasm for getting additional yield with the kind of risk that you're adding to the portfolio. So yes, it's been tough, I guess, is the answer.
Yeah, well, that makes sense. Like I said, I rather want you to do that. Very last question for you, and then I want to move over to the equity side. But just very quickly, I mean, you've got extensive experience in global markets. You've looked at global credit for many, many years, being UK based for a couple of years. You've got some allocation to global markets. I think if I remember that number right, roughly about 7.5% give and take. You've got some protection on that. So the currency fallout did help you. But on that global component, what is that? Are you buying more global credit, because the spreads appear to be very attractive? And on current levels of the currency, do you think you might protect a little bit more on that?
Yeah, so I guess good questions and topical questions. So I went into May where spreads had come in a bit with a lot of kind of very short-dated US Treasuries, effectively. So short-dated yield. The nice thing about, having been around for a long period of time, I suffered through the period of post-GFC with global yields at zero, and now yields significantly higher. So every time you took dollar exposure, you were really doing it through gritted teeth because you were giving up a lot on the yield basis. Now I can buy, as an example, and I have some in the portfolio, I can buy a South African government dollar issued bond above 7%. You're not giving up a great deal of yield to and capturing, getting, there've been times where we've also seen some of the SA related credit trade at 10, 11% in dollars. So there you're getting attractive yields. Those yields have come in a little bit, and so they're not as attractive. The South Africa spreads have widened, but the other sort of bank and corporate spreads have come in. So it's not quite as good as it has been, but it's certainly an area that I will look to take advantage of. And like I always like to say to people, don't think of offshore exposure as one, necessarily a dollar play or necessarily a credit play. It can be a combination of a number of things. So I could buy offshore credit, hedge it all back to Rand because I think the Rand's completely sold off. Or I can cover some combination of the two, which is where I am right now. Yes, the Rand has sold off a lot, but again, these risks, sort of are out there, and I do like it as a buffer. So I've been taking it sort of my sort of hedging the Rand is by buying more yield. So if the Rand does come in, that probably means that our yield's going to improve. So you kind of I can kind of think about those two in lockstep. But yes, probably take a little bit of that profit that I've had from the Rand sell-off when we see these big moves.
Indeed, a lot of moving parts there to consider. Maybe to step off the fixed income side, Ida and Charles, I can maybe on your equity fund, DFM's got this way to put labels on funds, but I mean, you would agree with that. It's momentum investing. Very little momentum driven or momentum investing equity funds in the SA space. I mean, if you go globally, there's hordes of them. In South Africa, we're very limited with choice. And a lot of those more well-known funds are super expensive. If I compare it to your fees, actually very attractive. Can you maybe for our audience unpack momentum investing a little bit more? How that comes together in your stock selection? Because if I look at your stock selection, it's very different to typical general equity funds and obviously the JSE. And that may probably explain the return profile of the fund, because if I look at numbers, last month, 6 months, 3 months, 1 year, top quartile, top quartile, top quartile, you dodged a massive bullet in May again, relative to the peer group. And I want to understand a little bit more how that process works in the fund when you get to stock selection level.
Yeah, Eugene, I think, as you mentioned, there's very few momentum managers, and the few there are is very more benchmark cognizant. So they will look at market caps when they allocate. We don't look at market cap whatsoever. We don't look at the benchmark. So we are stock selection universe based on volume. So I think that's the first biggest change. I think another big difference is we currently rebalance the fund much more frequently. We have smaller sub-portfolios that we rebalance on a weekly basis, whereas a smart beta, call it, will rebalance on a quarterly or 6 monthly basis. I think that's the biggest difference. And then another big difference is we don't have big allocations to stocks. Our biggest allocation will be 6% to a stock, whereas something like a nice fashion process can be upwards of 10% in the benchmark. So that's again mitigating those left-hand tail risk of something that can go wrong in a stock, and having a smaller exposure to a stock where something can go wrong.
Yeah, that explains it. Maybe a question from the audience as well. And Sabran, you can comment on that. And it's asking about the equity holdings of your equity fund and the preserver fund. Do you follow the same process? I would assume not in the preserver fund when you get to your holdings. So how do you get to that?
Yes, Eugene, I don't follow the same process for my underlying equities. Just looking after the market risk is enough for me. I don't want to look at the stock-specific risks as well. So in my case, no, I don't do any stock selection. It's purely holding the stocks in proportion to the index to reflect the broad market. And at this stage, I'm using the top 40 as a proxy for the JSE All Share Index. That might change if need be, but that's a nice liquid and a very representative index at the time. So passive in terms of stock selection, active in terms of beta management.
And I would guess that would speak to the structure of the fund, because the protection you deploy is through derivatives. And I would then assume those derivatives you buy would be on the JSE top 40. So you need to get a fairly close match in terms of what you're holding and what those protection strategies looks like. Am I correct in saying it?
You can carry on and market the fund. Thanks, Eugene.
Right. Okay.
Again,
my very next question. Yeah, no, sorry, continue.
That's one less risk that I want to look at, and that is the mismatch between my hedge and the underlying. So if I can keep my underlying closely aligned to, say, the index, and my derivative instrument is based on the index, then my hedge is nicely matched, and I don't get any slippage. Should markets turn lower, my hedge will kick in on a one-to-one basis.
And I mean, that probably also explains your smooth return profile and why there wasn't wobblies, because I've seen with similar kind of funds in the past, you know, if there's a mismatch between those two things, how things can fall off a cliff. But I mean, that's something you pay a lot of attention to and really works. Brings me to my very last question, and that speaks to how do you manage your protection levels given cash flows in and out the fund? How do you make sure that's always matched?
Yes. As I said, small inflows, they go into the spare wheel, the cash bucket. And in that bucket, I reflect the average hedge of the 4 strategies. So as markets move, those strategies will move, and that will be reflected on a day-to-day basis in the cash bucket. Should there be larger flows, I will then allocate, say, proportionally to 2 or 3 strategies to keep them evenly allocated, and purchase instruments that cover those flows at the then ruling market level. So keeping things matched over time. That's what I do.
Yeah, Does make a lot of sense. Gentlemen, unfortunately, we're very much out of time. I've got a couple of more questions, but we run out of time. For audience out there. If you need to get or want to get more information on Methodical, they've got a wealth or range of portfolios and funds, very different behavior to a lot of stuff out there that you are used to. Definitely worth considering and looking at, especially if you do blending in equity portfolios and you believe in style blending. You definitely have to look at momentum as a style. And like I said, very few options in the market, can't be ignored. The Methodical BCI Equity Fund. Gentlemen, thank you so much. We really appreciate it. And if our audience want to get in touch, give us a shout. All these managers are always very welcome or open to speak to you. We'll see you again next week, Wednesday. Looking forward to chatting you again. And to our Methodical team again, thank you so much for joining us this morning. It's been a great pleasure having you with us.
Thanks, Jim.
Excellent. Thank you.